Russia's invasion of Ukraine and the Federal Reserve rate hike cycle have unsettled markets and have left investors wondering how to adjust. I'm Abel, and here with me today are Mr. Heng Kun Hao and Mr. Anthony Raza to share their views on what investors can expect in the months ahead. Let me start with Kun Hao. What is the impact of the Russian-Ukraine crisis on global markets?
So our wish and hope is that, of course, peace will prevail in Ukraine. But the objective analysis is that this may well be a protracted conflict for months to come. And under most scenarios, the sanctions against Russia will stay. And this is the crux of the matter, because Russia and Ukraine are both exporters of key commodities to the world. If the sanctions stay, that means commodity prices will stay elevated. Now for crude oil, our view is that oil prices will stay above $100 per barrel and trend higher. Our analysis shows that every $10 rise in crude oil price will add about 1% to US headline CPI in the coming 6 months. The US Federal Reserve has rightfully sounded the inflation alarm. We believe the Fed will hike all the way up to about 2%. So commodity prices will stay elevated, inflation will stay persistent, interest rates will rise pretty quickly, and that's the risk to the global economy as a result of this Ukraine crisis.
What about your thoughts on the US dollar and gold?
So if you expect the Fed to front-load their aggressive Fed rate hike, this means that the US dollar will stay strong. Euro and renminbi will be weak because of growth slowdown. The Aussie will be interesting. It may be able to fight off dollar strength because of the jump in commodity prices. We like gold a lot. We believe that gold will rally strongly to $2,200 per ounce by the end of the year. So if investors need a bit of safe haven allocation, they need to consider some gold allocation.
Thank you very much, Kun Hao. Let me turn quickly to Tony. What is the impact on asset classes, particularly equities and fixed income?
At the start of the year, we were expecting that in 2022, we would see a return of a more classic expansion cycle that would be defined by strong economic growth, but rising inflationary pressures as the main drivers of markets. But in the first few months of the year, we have seen the global economy hit by a couple of growth shocks that have clouded this outlook for 2022. So more persistent than expected inflation and the Russian invasion of Ukraine and the subsequent sanctions have all clouded and made markets more uncertain. Nevertheless, we would tell investors that we don't think investors need to be overly fearful. We think that there is reason to be more cautious. We have downgraded equities to a neutral weighting, and we've kept fixed income as an underweight due to the risk of continued rising inflation. Nevertheless, in all times, we do think investors need to be selective with the opportunities presented. Within equities, we would highlight that valuations can be more attractive in certain regions and sectors. And while global corporate earnings growth is expected to be 6.7%, some regions like China is expected to be over 10%. And then finally, for income investors, we recommend focusing on Asian investment grade bonds and floating rate bonds, and also to diversify into dividend equities and real assets such as infrastructure and REITs to help protect against rising interest rates.
Thank you very much for your insights. There's a lot for us to unpack. For investors, we recommend the following actions. Invest according to your risk appetite, as the market can still remain volatile and fluid in the months ahead. Ride on market pullbacks to add to your portfolio in tranches, but stay diversified through our suites of multi-asset solutions, such as Capital Builder and the Simple Invest series. For income investors, our Income Builder series can help you diversify your income streams to hedge against rising interest rates. Our identified mega trends have remained intact, and investors can continue to add to their portfolios along several key themes. Sustainability and renewable energy will gain more investments as Europe moves to reduce its reliance on Russian energy. China continues to grow in influence in the global economy, yet valuations are very attractive at current levels. Technology breakthroughs continues to raise the potential for healthcare, which has seen recent resurgence. We also see opportunities in the US financial equities, which will benefit from higher interest rate margins as the Fed hikes rates. Broad European and Japanese equities are also undervalued, providing catch-up opportunities as the global economy continues to recover. For more information, speak to your UOB advisor today.